I think that Bitcoin is the most decentralized digital property, right? It's the highest quality digital property. We want to create a digital property running on a decentralized network that's owned by everyone and no one. I think that the number one critique right now of Bitcoin is it's volatile, but I don't think it's volatile because it's digital property, digital energy, or because of all of the constructive uses of it. I think it's volatile because there's too much leverage in the offshore crypto exchanges and the altcoins. I think that what's happening is someone buys an altcoin with a 10x lever, it moves up 20%. They cross collateralize into the second altcoin, and then they somehow collateralize that or they tie that into Bitcoin. I think that 20x and 100x leverage in the offshore crypto exchanges has been driving the volatility in Bitcoin. And I think that as we come off of that, I think that we're not going to see 20x leverage. Coinbase doesn't offer 20x leverage.
No, but the investment banks will. Because they can't help themselves, because that's where they see money is, I'm going to give somebody else, a bigger financial player, a hedge fund, for example, this kind of leverage.
Well, I mean, like we just saw the equity swap issue with Archegos play out. But I can tell you that I've traded with all the wirehouses for 30 years with hundreds of millions of dollars. They never offered me an equity swap. Okay, it's not very common to be able to get an equity swap, even if you have a $500 million portfolio. So 99%, maybe 99, everybody I know, they're not trading with equity swaps. The highest amount of equity or the highest amount of leverage you see in conventional markets is like 50% or 2x leverage. And so I'm not really concerned about that. The future of Bitcoin is transitioning into the public markets and the institutional investment markets where the leverage is normally going to be 2x or less. And I think that it'll be delevered more than it'll be levered. I think that if you look at the velocity of the crypto markets, people are taking 10x and 20x trades, and those things are being marked to market every minute of the day on the weekend with forced liquidation. The reason you get volatility is when you put 10x or 20x through something that's got, if I have a $2 billion market cap and $30 million of this stuff is trading, and I lean on it with 20x leverage against something else, then I'll move that number. If I'm cross collateralized and I'm able to go back and plug it into Bitcoin, you'll actually drive some Bitcoin volatility. But the volatility is coming from the crypto markets. It's not coming from conventional users of digital property or traditional institutions.
And also what's very different about this market is if you take leverage in the New York Stock Exchange or the futures market, you have margin. Somebody calls you up and says you need to pledge more capital. The crypto markets are the opposite. It's like, we control your margin, we'll liquidate you immediately. You get no choice. So you kind of know what you can lose. In futures markets, you don't know what you can lose, because in the end, if you can't pay your collateral the next day, your margin the next day, you're in shit street.
Yeah, I think the conclusion is, look, if you look at where Gensler is going, and where the regulators are going, they're going to regulate the stable coins. They're going to regulate the DeFi exchanges like Uniswap. They're going to put more regulation on the offshore crypto exchanges. They're going to put more regulation on the onshore exchanges. And as they do that, one of the consequences is leverage is going to get taken out of the system. The obscene amounts of leverage comes from, DeFi combined with offshore 20x, right? And if you go onshore, it's kind of hard to generate a 200x leverage play. In fact, as I said before. So you remember what happened when BitMEX went offline?
Yeah.
When they brought charge against Bit, I was trading in the market, Raul, and so like looking at it every minute of the day, like I very, very trading in it, like having the skin flayed off your back if you saw something go wrong. Like I watched Bitcoin go from $9,500 a coin to $10,500 a coin in 3 minutes, like while I'm on the phone. And then I went to bed and I was short. I was trying to buy it at 9,500. I was short and I went to bed and it came back to me by 3 p.m. the next day. But I damn near had a heart attack, right? Like literal heart attack. When BitMEX went offline, I watched half the velocity disappear. Sorry, half the volatility disappeared. Like you could literally see like the volume got cut in half and the volatility came way in. And so I think that you're seeing progressive waves of normalization as these markets get less levered. And I think that that's going to continue over time. I don't know that it will end tomorrow, but obviously my long-term thesis is you look out 2, 3, 4, 5 years, as more and more large institutions hold this with less and less leverage, the volatility on Bitcoin decreases.
Yeah, and as network effects take hold and more people own it, becomes less volatile, just because the nature of the number of people buying and selling each day just lowers that over time. So here's a final question I want to think about is, okay, let's go out 10 years now and just think about, okay, there's this kind of digital asset world with DeFi and everything else. Where's Bitcoin's role in that as the apex predator? What does that mean? Does it mean all DeFi is on Bitcoin, or it's a broadly spread digital asset world with this new technology and Bitcoin is the kind of base layer collateral of the entire thing? How do you think about that?
I think that Bitcoin is the most decentralized digital property, right? It's the highest quality digital property. We want to create a digital property running on a decentralized network that's owned by everyone and no one. Right? That's the real key. It can't pass the Howey test. We can't have, no one can shut it down. You can't have people upgrading it every quarter or every 6 months. You can't have a CEO of it. You can't have a CTO of it. You can't, you need to have something completely decentralized. Once you've got that, now the velocity of the digital property, and again, when you call it digital energy, you start to see it differently. You realize you can accelerate it on layer 2 platforms. And there are a lot of decentralized layer 2 platforms. So Lightning is a decentralized layer 2 platform. You could say that many of the other cryptos, to the extent that they're decentralized, they're layer 2 platforms, right? There's going to be a battle to see which cryptos are truly property versus which ones are security. And Gensler has said that on no less than 4 different occasions. He thinks many of these cryptos are security. So as we start to see more guidance there, he's also said some tokens are commodities. So as we sort out which token is commodity and which token is a security, you're going to have a competition of layer 2 tokens. The Lightning Network runs on a layer 2 on a token which is Bitcoin, right? Which is an interesting thing, but I think that you're going to see a competition there, and then you're going to see layer 3s, and layer 3s I define as CeFi, centralized finance applications like Square or PayPal or Coinbase or Binance, right? All of those are moving large sums of Bitcoin at high velocity. Square's got 30 or 40 million customers, and you can move any amount of Bitcoin from Square Cash Tag to Square Cash Tag instantly for free. So as you start to see those, they're going to create an accelerated finance. Between you and me, I'm not sure that decentralized finance needs a decentralized layer 2. It needs a decentralized layer 1. Like, you need digital energy to exist in order to move it at the speed of light 100,000 times an hour across 100 jurisdictions in order to do yield farming. So you need digital energy, and Bitcoin is. You need one. Do you need 2? Not necessarily. You need one digital token that you can move at the speed of light 1 million times a second